Thank you for finding me online. My name is Nathan Ruffey with Mortgage 101. Today we're going to talk about purchasing a property. There's a home buying in the state of California, Arizona, Nevada, and Utah. Those are the states that I'm licensed in. You need three things to be able to purchase a property. Three qualifying things on traditionally with Fannie Mae, Freddie Mac, USDA, VA, and FHA. I'm going to have some links below, or I would love for you to look through. I'm going to have a link to my podcast and also relative videos that will relate to you in regards to VA, USDA, the approved areas, great 100% program. We'll touch on that as well. Fannie Mae, Freddie Mac guidelines, and conventional. So conventional, VA, USDA, and FHA are those traditional guidelines, loan programs that people normally buy product on houses. The non-QM or non-traditional is going to be the stuff that, if you've been around a while, stated, no income, no asset loans, non-QM. They don't fit that traditional box of FHA, VA, USDA, or Fannie Mae or Freddie Mac. So they will go outside that box. I'm talking traditional only. That's all that we do here. That's all I specialize in. All that non-QM stuff is another different animal. But on the traditional financing, conventional, everybody thinks on conventional, which is Fannie Mae, Freddie Mac, you need to put 20% down. You do not need to put 20% down. You can put as little as 3% down for the down payment. So $400,000 loan, that's $12,000. $500,000 loan, these are purchase amounts, sorry, not loan amounts, purchase amounts. $300,000 purchase amount, $9,000. $400,000 purchase amount, $12,000. $500,000 purchase amount, $15,000. That's 3% of the purchase amount, whatever the purchase amount is at 3%. Now, if you break the county loan limit, there are certain floor limits right now, and they will change. They change almost every year right now. But there's a floor limit for most counties. Then the high counties, such as like Los Angeles, Orange County, San Diego, they will have a second tier base loan amount that you can't exceed. So you got the base loan amount, then you got the one more in higher counties. San Bernardino and Riverside, they have that minimum threshold loan amount that you cannot exceed. LA, Orange, San Diego, you can exceed that base loan amount on the second tier. If you do that, it's 5% down. So it's not that 3% anymore, because now you become called an agency high balance loan that you'll have to come in with at least 5% down. 3% down's minimum. You have to be a first-time home buyer, one of the two buyers. So if you're married and one person's owned a home in the last 3 years and the other one hasn't, you qualify for that 3% down. It just has to have one buyer on conventional to be a first-time home buyer. And a first-time home buyer, you could have owned a home 5 years ago, 10 years ago. If you have not owned property, which means you haven't had a lien against you or been on title of another property, you can be on title of your parents' home that's free and clear, but you're currently on title, you own a home, because you're on title of that property. You're not a first-time home buyer. So you cannot own real property either through a loan or through being on title with somebody. So you cannot do that. If you haven't done that in the last 36 months, you're a first-time home buyer. You could own a home 37 months ago, first-time home buyer on conventional. So below there, I'm going to have some links on conventional programs below. Like I said, I've done a lot of videos. I have a huge video library that you can look at, listen to some podcasts, and I'll have the link below to my podcast. FHA, everybody thinks this is a first-time homebuyer program. It's not. It's opened up to everybody that qualifies, of course. Minimum down payment is 3.5%. That's what you have to come up with. Now, these programs can have down payment assistance programs to come up for the required minimum down payment. You got to meet those requirements as well. But the FHA is not regulated first-time home buyers. Anybody can, as long as they qualify, can utilize that program with a minimum of 3.5% down. You can do more if you like, but the minimum is 3.5%. So a $300,000 loan, 10.5. Okay, it's 3.5% of whatever the purchase amount is up to the county and loan limit. FHA will have a different county loan limit than conventional. Okay, you have your purchase amount, then you have the loan limit, and they'll go up to. Past that, you're considered a jumbo borrower when if it exceeds that minimum loan limit. I don't want to tell you what the loan limit is, because as I'm doing this video in a couple months, it's going to change. It's going to probably go higher. It's probably going to go lower. So definitely call me and we can find out what the county loan limit is for that county that you're looking to purchase in. So FHA, not limited to first-time home buyers. Anybody can qualify for that. And all these, so we're doing just a down payment. We'll get into the credit. We'll get into income requirements as well on these programs. So FHA, no income requirements, certain credit score requirements on that, but the down payment's minimum 3.5% for FHA. VA, 100% financing of the purchase amount up to a certain limit, and that's changed. I think currently it's like $3 million you can come in. You have to put any money down. If you're a VA and you're disabled by the Veterans Affairs at 10% or more, your VA funding fee is waived. But this is a true, as long as you meet the guidelines and in the loan limits, it's 100% no money down of the purchase amount. You want a $400,000 purchase amount, you qualify. $400,000 will be a loan amount if you're exempt from the VA funding fee. The VA funding fees have increased over the last year, and whatever the VA funding fee that you have, that will be financed on top of the loan. Okay, right now it's 2.3% for first-time use. So if you do a $300,000 loan amount, purchase amount, $300,000, your loan amount is going to be, what is that, $306,900 is going to be your loan amount. So your loan amount will be higher than your purchase amount utilizing the VA, and then second time use is 3.6 right now. So those are higher. And if you're exempt at 10% disabled by the VA, you are exempt from that VA funding fee. USDA, another great 100% financing, no money for the down payment. There's no county loan limit for the USDA, but there is an income limit. So that's what's going to kind of strap you on that purchase amount with that limit. So those are the four traditional ones that we do. Conventional, 3% down minimum. FHA, 3.5% down minimum of the purchase amount. VA and USDA, no money down. 100% financing. Now, you got to qualify for all these, of course. You got to meet the income requirements, the debt ratio requirements, and the credit score requirements, and what's in the body of the credit report. Did a great podcast below if you want to listen to that. So we got the minimum down payment for these programs. They're income limits. There's no income limits for VA. There's no income limits for FHA. There's no income limits for conventional. You can make $1 million a year, and you can qualify for all three of those, FHA, VA, and conventional. The USDA, though, will have a income requirement. Now, USDA is not for all areas. It's in designated lending areas classified by the USDA, United States Department of Agriculture. So you cannot exceed a certain income threshold. It's pretty healthy right now where it stands, and it will change. It's only gone up, and it depends on the household of dependents that are going to live in a household. 1 to 4 people, and then 5+ people. That will change the income limits, and it's pretty healthy right now for that. So if you're looking at the USDA in your approved area, I got a great USDA video link below that you can check that out and find the approved USDA areas for you to purchase in. If you're looking in a high populated area, it's probably not going to be USDA. It's got to be a rural, like in California, mountain communities, Kingman in like Arizona, a lot of places in California, Arizona, Utah, and Nevada that are approved USDA lending areas. So definitely look at those, that video below. Okay, so we got income limits. No income limits on all those but the USDA. The credit scores, their minimum credit scores right now for conventional is a 620. Fannie Mae, Freddie Mac 620. You're not going to go any below that and be on that traditional financing. FHA goes down to a 500 credit score, but you got to find a lender that's going to go down to 500. The company I'm currently with goes down to a 580 credit score. Some companies have what's called an overlay. So FHA will say, we'll insure a borrower down to 500 credit score. You got to find a lender that can do that. Not all lenders are created equal. They're going to go, yeah, let me jump on that and lend to somebody at 525. They're going to raise that minimum called an overlay. They may say, hey, 580, 600, 620, 640, 680. Some lenders may not touch FHA at all. I know a couple that do not touch the USDA program. Their core is the VA or conventional. Some don't touch the FHA program. These are more banks that don't do that. But those are your traditional lenders programs that I'm talking about that will go down to 580 for FHA. 620 for conventional, that's Fannie Mae, Freddie Mac. VA 580 we go down to, and USDA will go down to a 620 They don't have a credit score limit. You don't have to have any credit, and then it's got to be a manual underwrite. But you got to find a lender that's going to do that. If 50% of the lenders do not do USDA, they don't know anything about USDA, they don't want to touch USDA, 50% of the lenders are gone. And then you got 25% of those that say, well, we're not going to do a manual underwrite on anybody with no credit score. So the credit score right now is a 620 with the company that I'm with right now. And that can change tomorrow. So definitely call me and see if guidelines have changed. Guidelines typically change at the end of the year, but they can change without notice. We get it all the time. Hey, this changed, this changed. So definitely speak with the mortgage professionals. Don't read anything online unless it is current, but definitely call mortgage professionals such as myself, and we can go through those programs with you. The USDA, find out what you need for income and the credit scores, FHA as well. So you got the income limits, the debt ratio requirements. Those will change as well. And we got to run everything through desktop underwriting, DU, or LP, which is loan prospector, with FHA, VA, and conventional. USDA is called GUS, and they have a specific guideline when it comes to debt to income ratio. You got your front end debt ratio, debt to income ratio. We take your gross income, not your net, on a W-2 wage earner. If you're a Schedule C employee, Schedule C filer, which is sole proprietor, or an LLC, a corporation, a K-1 filer, an S corp, we calculate those different than a W-2 employee. But we will take the gross, but we'll calculate the income. So we take the gross income, divide that, whatever your monthly, let's say you make $5,000 a month, you're making $2,500 a month in your mortgage, that's 50% utilization of your debt to income ratio. That's high. Conventional, 45, 40, maybe 47% max, as long as you have some compensating factors. Compensating factors, higher credit scores. 640 is not higher than that 620. We're talking 700, 720, 740, 780. So if you have a higher credit score, compensating factor, along with some reserve requirements, anywhere between 2 to 3 to 6 month reserve requirements, you can push the envelope on the front end debt ratio. The front end consists of the mortgage payment, which is PITI, principal and interest, property taxes, homeowners insurance, mortgage insurance, flood insurance, and HOA, if it has all that. Flood, we run flood. Every lender runs a flood on every single house, because if it comes under that you're in a flood zone, you're going to have flood insurance. Mortgage insurance will depend on the program, so that goes into monthly debt ratio. Even if you don't impound, which means you pay your property taxes and your homeowner insurance inside the mortgage payment, we still must calculate that, because you've got to pay your property taxes and you got to pay homeowners insurance if you carry a mortgage. So we still got to factor that in the debt ratio. Conventionally, certain percent down, you do not have to have an escrow account where you pay your property tax and insurance inside the mortgage payment. VA, not required. Most lenders want you required, but it's not required. FHA is required, and USDA is required. So you have to pay those within the mortgage payment, whether you want to or not. You got to pay those things in there. So that's your front end debt to income ratio. Principal and interest, property taxes, homeowners insurance, flood insurance, and your HOA. And you can have some special insurance that you may need as well. Earthquake insurance, we don't put that in there in some places that need, like California. So that's your front end ratio, debt to income ratio. Your gross income divided by what your monthly mortgage expense is going to be. Conventional likes to 45%. You can get away with almost 47. VA, FHA, you can go higher, about 49 on the front end. USDA is 29 to 32, depending on what your credit score is. The back end debt ratio is your gross income again, your mortgage payment plus your debt. Debt is the auto payment, student loans, credit cards, alimony, child support, any garnishments. We're going to have to put that in the debt ratio. So that is your back end ratio, and that can really push the debt to income ratio up if you got several cars on that you have under your credit. So back end ratio, conventional is 50%. The FHA, VA, 57. I've seen as high on a VA 65%. With the USDA, it's 39.42. Those are depending on what your credit score is on the back end. So USDA is very, very limited on the debt to income ratio. They're not going to allow you to have such a huge impact when it comes to your income going out towards debt. So you got all these factors on buying a house: debt to income ratio, credit scores. I just told you those, and I want to go what's in the body of the credit report. You may have a lendable credit score, let's say a 680, But what's in the body of the credit report still may hamper your ability to be able to purchase a property, such as collections, judgments, foreclosures, bankruptcies. There's certain limits on when that bankruptcy was discharged on when you can get an FHA, VA, USDA, and a conventional loan. If it was just discharged Chapter 7 6 months ago, but you still have a lendable credit score of 620, you're still not going to be able to get a traditional loan because it requires a certain amount of months, years past that discharge date. 13 is a little bit different, handled a little bit different than a Chapter 7. Chapter 7 is when you wipe everything out. 13 is where the court system says, no, you can't file a 7. You make too much money. We're going to roll you to a 13, which means you pay monthly to the court system and they pay the debt. So that's the difference between 7 and a 13, personal 17 and 13. So you can still get back into the purchasing world once those things have been seasoned. But if you have collections, judgments, you're disputing something that may have to get removed. So that's where, if you don't want to buy now, but maybe 3 or 4 or 5, 6 months down the road, or even maybe a year down the road, you want to buy, call me. Let's talk about getting you into position. Because if you're not in the position now to buy and you're not going to buy now, then let's look at your overall income, credit, and assets to say, hey, Mr. and Mrs. Consumer, this is what you need to do to get yourself in a lending position 6 months, 12 months down the road. If you don't have the income, this is what you can do with your income. Work overtime, save more money, go get a second job, do something on the income so you have that assets. Credit scores. This is what you need to do. Pay these bills down. Take care of this on the credit. And the credit's the biggest thing. You may not know what's on your credit report, your mortgage-related credit report, until you apply for a home loan. Now you want to purchase within a month. You're 6 months out. You're 12 months out because now you got stuff on your credit that you did not know and you could have cleaned up 6 months ago. So get with a mortgage professional, call me, and let's talk about your credit and say, this is the things you need to do over the next several months to get you in that lendable position. Income, we talked about assets, save money. The biggest thing that people do is you can work overtime. You can work a second job. You can work a bonus, commission. You can do something to get your assets increased for the down payment and the closing costs. I got a great video below. You want to click on that on what it will roughly cost to purchase a home where you're going to need to save money. Because money's key. You got to have some kind of money. Sellers can pay for your closing costs. They can't pay for your down payment. We can look at down payment assistance programs. That comes with a higher rate. You may make more money than the down payment will allow. The sellers can pay your closing costs up to a certain percent, depending on what the down payment and what you're purchasing a property for, investment or owner occupied. So there are ways to own a property, but it takes you, the consumer, to be in a lendable position. You may pay rent $2,500 a month. That doesn't mean you can have a mortgage payment and qualify for $2,500 a month. We need money for the down payment and the closing costs. There's a click on a link below to watch that video on what it's going to take to purchase a property. Income, your debt to income ratio. You may handle all your bills now and only be left with $100 at the end of the month. Your debt ratio is too high. Sell a car. Close some accounts in your credit. Quit using credit. Use ATM, or just stop spending. I look at people's bank statements all day. I can care less what you spend money on. That's on you. But if you want to save money, the biggest thing that I see on people's on bank statements is eating out. They eat out a lot, and you're probably chuckling because you probably do the same thing. Pack your lunch. Eat at home for dinner, lunch, breakfast. Don't go swing by Starbucks. Don't go do this. Don't go do that. What you can do, saving money, is just don't eat out. Save where you can. Cut back from the Amazon orders, anything that you may need. Buy all that stuff later. A lot of stuff you may not even need. The impulse is to buy it. If you're going to purchase a home, you got to save some money because there's some out-of-pocket expenses such as a home inspection, the appraisal that you're going to have to pay for. There's going to be probably a lot of open houses you're going to go to. You're going to spend a lot of gas. And then when you're out spending gas, you go, oh, let's just swing by the drive-thru and pick up something to eat. Don't do that. Take a snack so it'll hold you over. Take some of your own water. Don't bottle water, but water from the sink or water from your refrigerator and drink it in a container and take it. Just save as much money as you can. Right now, when I'm doing this video, we're in a high inflation right now. Everything costs so much. Gas costs so much. Food. A lot of things cost a lot of money. So you need to save where you can. Just save it, save it, save it. So you got your assets. You're looking to buy a home. Get yourself in the position to do that. And if it's not today, I can draw you up a blueprint, say this is what you need to do when it comes to income, when it comes to assets, when it comes to credit. If you truly want to purchase a home, it takes you to do these steps, such as income, make more money, work overtime, sell something of value that you don't need, maybe a car you don't need, a stamp collection, an art collection. You want to maybe sell that stuff. I'm just saying something of value. Sell it, get the receipt, save that money up, put it aside. This is your house account that you're going to purchase a property. Credit, if you have a lendable credit score, but what's in the body of it, listen, a 620 is lendable, but it's not going to be a great interest rate compared to maybe a 680 or a 720. And it might be easy to obtain those credits. Just pay stuff down. Don't open up credit cards. As I'm doing this video, Christmas is coming up. So with Christmas coming up, people want to spend money. People want to open up new credit. 3 credit cards and an auto loan. You're fine. You do not need anything more than that. Actually, one more credit card you don't need. Just get rid of it. But if you open up something, keep credit open. If you got a revolving credit card you've had for 5, 6, 7, 8, 9, 10, 20 years, keep it open. Even though you have not used it, keep it open if you don't use it. That has a long history on the credit report versus something you just opened up a year ago. You use the old one first so it stays open, because remember, these creditors will close your account if you don't use it. So use it. So we can look at your credit, we can look at your income, and we can look at your assets. Let's get you in the position of purchasing. And some of the stuff might be hard to swallow. What you got to do is change some of your lifestyle to own a home. But believe you me, it is worth it to own something. As I'm doing this podcast video, rents are going up. Everything's up right now. But get yourself in the position so when things are in your favor to purchase, because the only people who are going to know that you can buy is you. You're going to know when the time is right. But if you're making a rent payment of $2,000, $2,500, $3,000 a month, in some cases, like in California, $4,000, $5,000 a month if you're close to LA or Orange County, that's a lot. You can own a home for that. But if you don't have the credit to own a home, let's work on it. If you don't have the assets to put for the down payment or closing costs, let's work on it together. I can do that blueprint for you. So if you really want to purchase a home, let's get you in the position when it comes to income, assets, and credit. Thank you very much. Subscribe, like, comment. All my information's below. I got tons of videos in my library that you can look at when it comes to credit and income, and I'll put some of those links below. But check out some videos on my podcast and my YouTube channel. Got a lot of information on there, useful information. But if you want to call me direct, it does not hurt to have a conversation. I'm not going to push you into anything you do not want. I want to talk to you and have a conversation about what you need to do to be able to purchase a home. If it's not now, if it's later, then it's later. Okay? Let's just do this together. Nathan Rufty at Mortgage 101. All my contact information is below. Thank you very much for taking the time out of your day to listen to me. Comment, like, and share. I would love those thumbs up and comment and share this video if you know anybody, coworkers, family members, neighbors, looking to purchase or refinance a home. Love to have a conversation with them to see what they can do and what we can offer them. Thank you very much and have a great day.